Hi guys, how are you today? I hope you're always in good condition. So today we talk about accounting. First, the meaning of accounting. Accounting is one of the key of function for almost any business. Accounting is the practice of recording, classifying, and reporting on business transactions. It provides feedback to management regarding the financial result and status of an organization. Now let's take a look at the accounting component. Accounting components: assets, liabilities, stockholders' equity, revenue, expenses. Next, accounting financial statement. Financial statements are reports prepared by a company's management to present the financial performance and position at a point in time. A general purpose set of financial statement usually includes a balance sheet, income statement, statement of owner's equity, and statement of cash flow. Here, more information about the company's financial statement.
Income statement. Income statement, also known as the profit and loss statement, report the company's financial performance in terms of net profit or loss over a specified period. Income statement is composed of the following two elements: revenue and expense. Net profit or loss is arrived by deducting expense from income. This is an example of the income statement.
One single step: revenues and gains. Sale revenues plus interest revenues plus gain on sales of assets. So, total revenue and gains. Expenses and losses. Cost of goods sold plus commission expense plus office supplies expense plus office equipment expense plus advertising expense plus interest expense plus loss from lawsuit. So, total expenses and loss. Next, the final result: total revenue and gains minus total expenses and losses.
Next, multiple step. Multiple step is a kind of form of income statement. This form have a 3 column and usually have a 3 or 4 column. This form is details of a revenue and cost of goods sold and expense, and in the end make a net profit. In this example, we can see that there are 4 columns to put the value of an account in the income statement. As we know, that income statement provides information about net or loss profits, which is the result of the difference between income and expense. In this example, we can see that the cost of goods sold section is more detailed than the single step. In the revenue section, it can be seen that to get net sales, must readjust sales with sales discount and returns. After that, we must calculate the cost of goods sold to as beginning inventory plus purchase plus in, and then reduced by purchase discount and purchase returns. Then there is goods available for sale. Then subtract the goods available for sale earlier with ending inventory. Then the cost of goods can be sold. Then reduce net sales with cost of goods sold to get gross profit. Then add up all expense and make it a deduction from gross profit. So we get net profit before tax. Finally, subtract net profit before tax with income tax, so we can get the net profit that we are looking for.
Statement of change in equity, also known as the statement of retained earnings, details the movement in owner's equity over a period. The movement in owner's equity is derived from the following component: net profit or loss during the period as reported in the income statement, share capital issue or repaid during the period, dividend payments, gains or loss recognized directly in equity, effect of a change in accounting policy or correction of accounting error. For example, this is statement of change in equity.
First, there is initial capital, then net profit and proof are deducted. Capital addition and subtraction is reduced or added to the initial capital, so that will get the final capital.
Statement of financial position, also known as the balance sheet, presents the financial position of an entity at a given date. It is comprised of the following three elements: assets, liabilities, and equity. This is an example of balance sheet.
The balance sheet is showing that what we are trying to balance, assets on one side and liabilities and owner's equity on the other side. There are current assets and long-term assets. Accounts like cash, accounts receivable, prepaid rent, and inventory are belong to current assets. Then total up the current assets. And accounts like leasehold improvements and accumulated depreciation are belong to long-term assets. Then total up the long-term assets. Next, total up the total assets to show how much assets. And on the other side, liabilities. So, accounts like accounts payable, accrued expense, unearned revenue are belong to current liabilities. Then total up the current liabilities. Next, we only have one account in long-term liabilities. And then total up the total liabilities. For owner's equity section, we have retained earnings and common stock. Then total up the owner's equity. Next, take the total of liabilities and owner's equity. And last, check doesn't it match to total assets.
Cash flow statement. Cash flow statement presents the movement in cash and bank balances over a period. The movement in cash flow is classified into the following segment. 1. Operating activities represent the cash flow from primary activities of a business. 2. Investing activities represent cash flow from the purchase and sale of assets other than inventories. 3. Financing activities represent cash flow generated or spent on raising and repaying share capital and debt together with the payments of interest and dividends. This is example from statement of cash flow.
First, cash flow from operating activities, and we have received from revenues minus cash payment for expenses to give net cash from operating activities. Second, cash flow from investing activities, and we have purchase of equipment. Lastly, cash flow from financing activities, and we have investment by owner minus drawing by owner to give net cash from financing activities. Of the three classification will produce the actual cash amount from net cash operating activities minus net cash to investing activities plus net cash from financing activities.